This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 268. And Ben, another incredible guest that you're able to find for this week's episode. We welcome Professor Itzhak Ben-David, and we had an incredibly diversified conversation about so many different but wildly fascinating topics in the area of finance. So let me set up the background, then you can jump into more details. So Professor Ben-David is the Neil Klatskin Chair in Finance and Real Estate at The Ohio State University Fisher College of Business. He is also the Academic Director of the OSU Center for Real Estate. He holds a PhD in Finance and an MBA from the University of Chicago, a BS and an MS in Industrial Engineering, a BA in Accounting from Tel Aviv University, and an MS in Finance from the London Business School. So why don't you take it from there with that setup?
I mean, listen, this is another case of I'd read many of Professor Ben-David's papers, and it just came to a point where I had to invite him on. There comes a point where it's like when someone's got so much interesting research, especially in this case in so many different areas. That's one of the incredible things about his research, but also about this conversation, is that it's and we didn't even touch on some of his major areas of research. We didn't talk about real estate, which he's got a ton of research on. But I mean, that's the story. There's so much interesting stuff here that's relevant to financial decision making at the household level that we had to have him on.
We went from research around Morningstar ratings and the change that happened in 2002, hedge fund fees with some mind-blowing data in there.
I say this in the episode too. That paper is just incredible. It's this counterintuitive thinking that your intuition would never pick this up. It's the idea of hedge fund fees. How much do you actually pay when you invest in hedge funds? It's not 2 and 20. I won't spoil the answer, but that's an incredible paper. We talked about ETFs too. That's how we kicked off the conversation on the impact of ETFs on the underlying securities, but also the impact of ETFs on investor outcomes. ETFs as a form of financial innovation and how they impact investor outcomes, and that, like, is more choice good for investors? Kind of is the theme there, but that's just fascinating stuff.
But wait, there's more. We jumped into calibration, CFOs and how they calibrate, and overconfidence. And then, just for some spice at the end, we dove into tax refunds and the mental accounting that people do with their tax refund amounts.
Yeah. How do people treat their tax refunds, and why do they get treated differently from the rest of their income? And that's one that's just so relatable. But to see it investigated rigorously is great.
A lot of it. It was all relatable. It was a great conversation. And Zahi, he's a really, really nice guy too. It's a really fun conversation.
Yeah, I enjoyed it immensely. So I think that's a good enough introduction. We'll go ahead to the episode with Professor Itzhak Ben-David. Professor Itzhak Ben-David, welcome to the Rational Reminder Podcast.
Yeah, thank you for having me.
All right, so let's kick it off. What is the current state of the ETF market?
So when we think about the ETF market worldwide and in the US, we see thousands of ETFs. In some markets, you have more ETFs than stocks or securities being traded.
Yeah.
And if you think about the ETF, the history of the ETFs, they started in 1993 with a SPDR. Originally, this used to be targeted towards institutional investors who wanted to invest in the S&P 500, but didn't want to hold futures because they don't allow direct ownership of the underlying securities. ETFs do. And in the 90s, it kind of developed. The QQQ joined at some point. So we started kind of with broad indices. And as the industry developed, there was fee compression. So the competition was really about how do I attain most liquidity, best coverage of indices at lowest fees. Now, think about generating a new product into this market. What you want to do really is to find something that is going to be compelling for investors. Probably doesn't exist already in the market because competition is difficult. So what we see is that more and more new products have been introduced, and each one is kind of differentiated a bit from the existing products. New products become kind of going after greater niches in the market, appealing to more specific groups of investors. And so if you look at the timeline, you see kind of broad index or broad-based ETFs. Later on, you see both smart beta. These are like the value and growth, dividend paying and such. We see sector and industry ETFs. Now we're kind of looking at the mid-2000s. We start looking at thematic ETFs. So basically, these are ETFs that are defined around a very specific topic. So these could be firms that have something to do with vegan foods, or firms that has to do with sins or no sins, or attached to a religion, or firms that their board support Trump, or something like that. So, when we look at the industry today, 2023, we see kind of the history of all the ETFs that were launched in the past and survived.
Yeah, it's super interesting. And I guess right now, lots of maybe AI thematic ETFs being launched.
Oh, yeah. So go ahead.
So when you look at ETF issuers, how are they deciding which products to launch?
Right. So think about the three of us deciding to launch an ETF. How would we go about it? Well, we know that it probably costs around $100,000 to launch a new ETF. We probably can't compete with BlackRock or Vanguard. We don't have the economies of scale. So we're not going to go for a new S&P 500 or a new NASDAQ-based ETF.
Right.
We're going to look for something that investors will be interested in, that we will be able to generate some fees, and probably something that has less competition than other. So maybe something based on AI, something based on the current topic, maybe something anti-woke or for woke, or some other topic that investors care about. Right? Now, one way to know what investors care about is just to read the newspapers and see which types of stocks or which stocks performed really well. Right? This means that investors are probably excited about these type of stocks. So if you look at the recent history of ETFs, think about like 2020 COVID period, we saw ETFs dealing with vaccines. We saw ETFs holding firms related to work from home. These are kind of hot topics, right? Things that investors are interested in at the moment. So I think this is, for the three of us, this perhaps could be an interesting venture.
It's crazy though. Like I saw somebody tweeted maybe last week about a cannabis ETF that has now lost 90% since it was launched.
Yeah, this is so 2019. Yeah. Cannabis, right? It can join the vegan foods and yeah.
How does a broader menu of ETF options affect investors?
Oh yeah, so you could think about ETFs as value enhancing, right? This is about democratization of investments. These are tools that were very privy to professional managers before, and now are available to anyone, right? I mean, if you were a retail trader in early 1990s or late 1980s, you couldn't trade the S&P 500 in one trade, right? And today, from the ease of your smartphone or your palm, you could actually trade the S&P 500, take a long position, short position, leveraged, etc. So one view is that this is about democratization of investments. We allow investors more power. A second view is what is called a competition for attention. So this view is a general view of competition, and it basically says, consumers have limited attention. So when you launch a new product, whether this is a yogurt or an ETF, you need somehow to attract your consumers' attention, investors' attention here. So how do you do that? Well, one way to do that is to compete on price, lower spreads, better liquidity, get more value for your money in a way. And the other is called quality. And quality here is very general. Here's a new flavor of yogurt. Here are Oreos. Here are things that, sprinkles, maybe something about the way that the product is designed or called. So ETFs are, in my view, and based on our results, are no different from other types of products. You need to make them attractive. How do you make them attractive? Well, if you have an ETF that invests in biotechnological firms related to COVID, let's call it Germ. If it's an ETF that invests in the restaurant business, let's call it Byte. So let's make it attractive. Let's use social media. The fees are kind of not so important, right? I mean, in a way, you're selling an idea for investors who would like to take a bet on some direction of the market or direction of an industry. So back to your question, is this good or bad? It's the same. We could ask the same question on the shelf of yogurts in the supermarket. Seeing so many types of yogurts, so many niche combination of flavors. Is this good or bad? It's probably good. There is more choice, but maybe it attracts. Sometimes it's not super healthy. So it's a question of, it's almost a value judgment question.
So there's these two possible explanations that the proliferation of ETFs is democratizing access to investments, and the other view is that it's a competition for attention. Which of those explanations or which of those theories better explains what we actually see in ETF markets?
Yeah, so this is very interesting. So it's clear that in the early days of ETFs, when we think about broad-based ETFs and potentially smart beta and maybe some of the sector ETFs, we're talking about democratization, right? I mean, think about the use for institutional investors. Clearly, there is gains from efficiency here. Now, as the industry developed, we see, as I said, we see more and more niche ETFs, which seem to appeal to smaller segments of the market. Now, when we look, we call these specialized ETFs. So these are the sector and industry, and those that are based on themes. So you would think, or at least potentially, these ETFs appeal to investors' sentiment rather than to kind of more efficient long-term portfolio hedging or portfolio minimizing costs of investments.
Based on your research, how would you describe the market for specialized ETFs?
Right. So specialized ETFs are those that are, these are about 50% of the entire spectrum, and they, in terms of number of ETFs, these ETFs are actually very interesting. They tend to be relatively small, but they charge relatively high fees. So if you think about the US market, as of a couple of years ago, they hold about 1/6 of the assets, but they generate about 1/3 of the fees of the industry. So it's relatively high fees, small assets. They tend to be very concentrated in specific industries or themes. So you could think about real estate, you could think about vegan food, inflation-related, AI, Trump supporting, etc. So these are tend to launch in relatively hot topics. Again, back to our joint venture. How do we find the best performing ETF? Best performing means that we will need to attract interest of investors. So it needs to be kind of a hot topic. Now, we observe a very interesting life cycle. So these specialized ETFs tend to launch in niches or corners of the market that experience very high returns in the earlier 12 to 24 months. Okay. But going forward, they actually have disappointing performance. Okay, and we record about negative 30% over 5 years. So these are alpha, an alpha of negative 30% over the course of 5 years. These are bad investments, right? Now, why is that? Well, maybe it was cool to invest in work from home in October 2020, but a year later, it's not such a great, it's not such a great investment. In fact, if anyone wants, I can probably help you find a Peloton bike, a used Peloton bike for sale. So, this is just the nature of investments. Things that are hot today tend to be, on average, cooler in the coming month or coming years. Now, there are two points to make here. One is you might say, well, these thematic ETFs and sector ETFs maybe are somehow used for hedging. Now, we all of us pay for different types of insurance. These insurance contracts, for us, the consumers, are what we call negative NPV. So, on your life insurance, on average, you're going to pay more premiums than have receipts. Is this a good investment? Yeah, it is a good investment because, it diversifies our portfolio. So maybe it's the same thing with ETFs. Maybe investors are willing to accept some low performance for some hedging. The issue is that if this were the case, then we should observe them being, kind of agnostic to this low performance. Why would you, you shouldn't care about this low performance. You know that it's going to be low performance, going into the contract. But we actually observe the reverse. We see that investors are super sensitive to performance. So after good performance of these thematic ETFs, they push more money into them. After bad performance, they pull money out of it. So this investment performance or flow performance sensitivity is very high, especially in those thematic ETFs, which tells us that they are probably being used for taking bets. So these are more speculation tools. But on average, the trend is down. Now, you may wonder, why do they perform before launch and underperform later? Because before launch, they are really, if you look at the historical indices of these newly launched ETFs, they are pretty impressive. So it goes back to our joint venture. When we're looking for a new ETF to invest in, we're just scouting the market, seeing what's hot now, and we maybe identify 2 or 3 corners of the market. We define our ETFs. It's going to take us about 3 to 6 months to put it on the market. There is a prospectus, there is a comments period. By the time the ETF is going to be launched, our topic may not be our definition of the ETF, or the subject of the ETF is not going to be as interesting. There might be a new AI, there might be a new, who knows what. But by this time, the party is kind of over, right? Some retail investors may still be interested in investing in our ETF, so maybe we're not going to lose money as issuers. But from an investor's point of view, this is already kind of the end of the party, right? This is kind of the end of the high performance. From there onwards, it's kind of shedding away the overvaluation. Now, this is also, you could see it in another phenomenon in these specialized ETF. They tend to liquidate more often. So if you compare the broad-based ETFs, they are kind of not attempting to generate any alpha. They're not appealing to investors who try to make super strong bets. They are maybe a way to park your money. With the thematic ETFs, they have a very short life cycle. So, when you see a new thematic ETF, you should ask yourself probably, are we at the top of the market now in this particular corner of the market?
Yeah, that's so good. I love the hedging point, that if these were being used as hedging tools, investors would hold them despite negative returns because that's what they expected. But instead, we see the performance chasing. It's fascinating.
Absolutely.
So given all that, what do you think someone who has had their attention grabbed by some sector or thematic ETF, what should they be thinking about?
Yeah. So in general, the advice to retail investors is don't, right? Don't be a retail investor. Try to, keep a well-balanced portfolio and, not react to every little move in the market. Thematic ETFs appeal to this type of investors who are being driven by sentiment. And, on average, they're going to lose 30% over 5 years. So the best advice is, of course, I should say, no financial advice, but based on my research, maybe try to avoid these opportunities. And if you feel very energized, you may short sell them. They basically mark the hottest trends.
Right.
So the way to think about it is there is some overvaluation in a particular corner of the market. You're going to see an ETF coming and offering more of the same thing to investors. If you see that, this is on average a signal for overvaluation.
If we think about impact on the market, how are ETFs different from other investors like mutual funds or hedge funds?
Right. So the big innovation of ETFs, or one of them, was that it is traded continuously. By comparison, mutual funds are traded, or you could place your orders once a day, and the hedge fund, the mutual fund is going to place your or utilize your funds in the next day or next coming days. So there is much more synchronous activity in the ETFs. Now, ETFs are used both by institutional and retail investors. Mutual funds tend to be more retail investors, sometimes through financial advisors. There is something, I think, in the both fees and speed of ETFs versus mutual funds. Mutual funds seem to be used for short-term bets because of their liquidity, because of their accessibility. Now, hedge funds are perceived by many as a more long-term investment. Many of them have some sort of liquidity restrictions. You can't invest in and out in a hedge fund. Right? I mean, you have to place your money for 3 or 6 or 6 months or maybe a year at least before pulling it out. So a hedge fund is more kind of a long-term investment. So are mutual funds. ETFs are used kind of for more short-term bets.
How does ETF ownership affect the volatility of the underlying securities?
Right. So the continuous trading of ETFs comes at a price. The reason is that both the ETF and the underlying securities are traded in parallel. So you could think about the ETF. Let's take an ETF that trades an index like the S&P 500. Think about some demand of investors pushing the ETF up. Now the ETF may rise, say, from the opening of the market until say until noon. Maybe it rises by 1%, but the underlying stocks of the S&P 500 may not have risen so much. Okay, so by if the ETF wants to trade or to track the index perfectly, then there needs to be some sort of a arbitrage mechanism between the two, kind of making the returns of the ETF and the underlying the same, because this is what the ETF tries to achieve, mimicking the underlying market or the underlying index. So ETFs do it in two main ways. One is that the ETF itself issues and redeems units. So basically, there are the approved participants. Some large financial intermediaries may go and collect. In our case, the ETF rose more than the underlying. Some financial intermediaries are going to collect some, buy some shares from the underlying and transfer it to the ETF for a price. So it's going to be kind of a way for the ETF in a way to expand itself, but in a way moving some of the run up in its price to the underlying securities. And another mechanism is just the arbitrage by market, just normal market participants. If I see that the ETF rose more than the underlying securities, maybe there is an arbitrage opportunity here. Maybe I should buy some of the large participants in the S&P 500 and short sell the ETF. By having these pressures in both directions, it allows the ETF and the underlying securities to have similar returns. Now, the issue is that ETFs may receive some idiosyncratic demand shocks. So let's assume that maybe someone on social media says, let's buy the S&P 500 today. So there's going to be some demand shock unrelated to the economics of the underlying securities. So the ETF will rise by the arbitrage mechanism. Also, the underlying stocks will increase. So the ETF is kind of a transmission mechanism, really, between demand shocks of investors to the underlying securities. Now, this might be perfectly fine if these demand shocks were completely related to the cash flows of these firms, right? Suppose we say the US economy is doing great, let's all buy the S&P 500. This is going to be a very legit way to transfer information. However, as we know, financial markets are noisy, and some of the securities are less liquid. So this type of shocks could be transmitted and basically create mispricings. And this is what we find in one of our studies, that ETFs could actually push stocks in one direction, could be up or down, but it's going to be actually a mispricing. So there is some random or arbitrary shock to the ETF. There is some arbitrary demand to the ETF, and basically it's going to push the underlying stocks in the same direction.
So we had a guest tell us a while ago that I think the language that he used was that ETFs are a pricing vector for less liquid securities. So they're putting information into prices that just couldn't get into the price of the underlying because it's not liquid enough. How do we separate those two hypotheses? Like, how do we know that we're getting noise as opposed to fundamental information?
Right. So I should say that they're not necessarily mutually exclusive. Right? You could have an instrument that adds to information, but at the same time increases also noise. So these two could increase, simultaneously. So in the case of our study, we were asking, do they add noise? And we have some evidence showing that it does. So a key component here is to find a shock to demand that is unrelated to the fundamental cash flows. Right? So you would like, in a way, more people to own ETFs that own the underlying shares in a way that is unrelated to the cash flows of these firms. And what we do in this study, we look at the reconstitution of the Russell 1000 versus the 2000 indices. So what happens there is that if you think about the Russell 1000 holding the largest 1000 shares in the economy, the Russell 2000 holding the next 2000, stocks that are around the cutoff, around the 1000, say between 950 and 1050, right? Many of them are going to switch indices at the course of their reconstitution. Their reconstitution happens once a year. So imagine you're this, imagine a stock that is the smallest one on the Russell 2000, Russell 1000. Okay, so it's maybe a stock number 970. So this stock has relatively small holdings at the ETF that manages the Russell, that tracks the Russell 1000. Suppose you didn't perform that well that year, or other stocks perform better. So you're kind of pushed from 970 to say 1050. Okay, suddenly you're one of the largest stocks in the Russell 2000. Mm-hmm. So ETF ownership is going to discontinually increase at around the reconstitution date. So suddenly we have much more ETF ownership. And what we see is that these stocks tend to have higher volatility after their reconstitution. And this volatility returns tend to revert. So these are not permanent changes, but rather volatility that basically reverts. And these tend to be noise. Now, this doesn't mean, as I said, this doesn't mean that there is no more information, probably macro information, because if people trade the Russell 2000, maybe they take bets on the entire economy. So maybe there is more information transmission, but at the same time, there is also more noise.
So just to further that a bit, Zahi, how does ETF-related volatility affect the expected returns of stocks?
Right. So what we observe in our research is that stocks with higher ETF ownership tend to have higher volatility and higher expected returns. So one way to think about it is that this is an undiversifiable risk. That this is how investors perceive this type of volatility. I should say that this area of research, I think, deserves more investigation, because the impact of ETFs is just phenomenal on the markets. I mean, the markets of today, almost this year, 30 years into the invention of ETFs, is dramatically different than 3 decades ago. So there is a lot to study in this field.
Fascinating stuff on ETFs.
Yeah, thank you.
All right, I want to shift to mutual funds, which is also fascinating. What do we know about the behavior of mutual fund investors?
Right. So there have been several empirical phenomena, things we see in the data that have been documented in the literature. So the first one is that we observe investors chasing past returns. So mutual funds that perform the best tend to receive most flows. We call it return chasing, performance chasing. The second one is that a performance usually does not persist. So it seems that investors or money goes after past performance, but this performance, once its money arrive to the fund, it does not persist going forward. Now, let me also add that the field of mutual funds is very interesting from an academic point of view, because it allows us to study how investors place their basically money, right? I mean, if you think about just the stock market in general, stocks change hands. So whenever you buy a stock, I may be selling So the supply of stocks or supply of shares is constant, between issuances or repurchases, but it's generally constant. So we can see volume, we can see transaction volume, but we don't see an increase in investment on an ongoing basis. In mutual funds, we can actually see mutual funds contracting and expanding. So it allows us kind of a view or a perspective to how investors think, what do they value, do they think, for example, think about like past performance? Do they care about past performance of the last month or the last year or the last 3 years, or how do they think about what is important in terms of performance? Now, these two phenomena that I mentioned, chasing past performance and past performance does not predict future performance, has basically multiple explanations. And the two interpretations that kind of got most traction is one that is kind of rational. So investors try to find the best mutual fund manager. They scan the universe of mutual funds, and they found those that performed really well. I mean, obviously, if you're a good mutual fund manager, you should perform well. They put their money there, but because so much money goes to these funds, basically they exhaust all the opportunities, all the alpha opportunities. So this is what we see. We see money going after good performance and no alpha going forward. This is the Burke and Green 2004 famous paper. It's a theory paper. Another interpretation is that there is relatively little persistence in general, and investors just chase noise. Some funds do better than others just because of luck. And think about like each fund manager, flipping coins, and we invest in those that have the longest streaks. Going forward, it doesn't guarantee any persistence. These are just flipping coins.
It's a big deal, right? Because we talked to Jonathan Burke a while ago, and we've talked to Ken French, because they kind of have each a big paper on the learning side and on the luck side. But it has big implications for how we view mutual fund managers. Are they lucky or are they skilled? It's interesting stuff. Of those interpretations of mutual fund investor behavior, which one makes more sense to you?
I'll tell you about the research in a few moments, but my prior coming into this research was that mutual fund investors are, remind me some family members. We're just, not financial experts. Where do you invest your money? Well, you look at the Wall Street Journal and you find, the league table, and probably number 1 is great. It's probably better than number 10. Or a mutual fund that is not in this list, right? I oftentimes like to think about mutual fund investors as Homer Simpsons, right? I mean, these are households. You look for the tastiest donut, how would you make an investment, right? I mean, some other studies, maybe we could get to them later, think that investors somehow calculate betas and alphas and factor models, etc. Given that most households or individuals can't even distinguish between index fund and actively managed fund, what do we expect from them, right? I mean, how would you hypothesize even, or your prior would be different than investors are just looking at league tables or looking at past returns. For just as a tidbit, what I mentioned earlier about lack of persistence and flows chasing past performance appears not only in actively managed funds, but also in index funds, right? I mean, in index funds, there is no manager. It's just an index. It's similar to an ETF. Right? It basically follows either a sector or the entire market. We see exactly the same phenomena. Investors put more money after good times. Going forward, there is no persistence in this performance.
Oh, that's interesting. So in index funds, there cannot be any learning because there is no even attempt at. Yeah, that's super interesting. Really interesting.
So it might, any explanation on learning needs to find difference between the behavior in mutual funds versus active mutual funds. So this is kind of a good litmus test for, is this learning explanation, holds water in a way, right? I mean, and interestingly, the studies that you alluded to earlier look at actively managed funds only.
Yeah, that is interesting. I got to say too that in our world of financial advice, I think that this behavior is even common there in a lot of cases. Like I've had many conversations with other financial advisors who are supposed to be the professionals, and they talk about, well, why would I use this index fund for my client when this active fund has outperformed over the last 5 years? Why wouldn't I just pick the active fund?
Of course. Yeah. I mean, why would you want to invest in a fund that lost, 20% in the last 3 years, right? I mean, what's the, even if it's, I must say that even for financial professors or professors of finance or finance experts, it's just difficult, right? I mean, why would you invest in something that have showed you already that it doesn't generate wealth? So it is tough, right? I mean,
wow, yeah,
for sure.
How can we learn what investors care about from the mutual fund flows?
Right. So the way to think about mutual fund flows and the information environment, performance being part of it, is almost like horse betting, right? I mean, we have different mutual funds competing for flows, and we see investors placing these flows on a monthly basis. So we could actually observe which ones appear to be more attractive. So, let me give one kind of example. So think about two funds, and the one fund A did 5%, has an alpha of 5% and a beta of 0. So meaning whatever the market does, this fund generates 5% every year. Fund B has no alpha, no skill. Basically, it gives you the market back. Okay, so it has a beta of 1. Now, suppose last year, the market went up 10%. So this means that Fund A still generates 5%, regardless of what the market does. Fund B gives you back the market, 10%. Let's forget fees. Now, which one do you prefer? So if you're a sophisticated investor, you will say alpha of 5 is great because it's higher than the risk-free rate, say, and it's an alpha, right? It's better than what I could get in the bank. It's risk-free, etc. If you're chasing unadjusted returns, you don't understand the whole beta issue, alpha, beta, you will go with Fund B because it generated higher returns. So this is a way for us to understand whether investors understand market risk, for example. Now, you could extend this example also to other types of factors. You could do 3 Fama-French factors. You could do 4 Fama-French factors. So this kind of this is why mutual funds are so attractive. You could run this kind of experiment on names of funds. You could do about the history of the fund. Do investors prefer short history of performance or long history of performance? So it's almost like a good lab to understanding investor preferences.
So when you do it, because you've looked at this, what do the mutual fund investors care about?
Oh, it's a great question. So it's been a long debate for many years. I stayed on the I personally stayed on the sideline. There were 2 famous papers that found that investors chase CAPM, meaning that they care about CAPM alpha as opposed to unadjusted returns, and for me, didn't square with reality or the reality I knew with my priors. So I decided to kind of jump in and with a group of co-authors and just study this area. And one way for me to look at data is look at summary statistics. Before running any sophisticated econometric specifications or regressions, if you just look at the data and ask, where do investors place their money? Is it in funds with top Morningstar ratings, funds, the same number of funds with the top alpha, the top unadjusted returns, the top 3 pharma French factors, etc.? Where do they put their money? You see that through the entire history, since you could go back to the 90s with our data, investors place their money where Morningstar stars are, and in addition, Morningstar. We can talk more about Morningstar, but Morningstar is highly correlated with past performance, unadjusted past performance, so no alpha, but rather raw returns. So basically, if investors choose between different funds, they go after Morningstar, the highest Morningstar ratings, the highest adjusted returns. If you look at the time series, which month or years we see more inflows to the mutual fund industry, this is going to be about just unadjusted returns. It's not alpha. Alpha is almost zero by definition. When you look at every month, it's going to be around zero. It's really about the unadjusted returns. After good stock market returns, money flows into the stock market. After bad ones, money, there are outflows. So we find actually no alpha chasing whatsoever. It's all about Morningstar and unadjusted returns.
That's crazy. So to follow on that, what is actually going into the Morningstar ratings that's driving the flows?
Right. So Morningstar has been around since the mid 80s and became really the industry dominant rating firm since the late 80s, early 90s. And it basically generates a rating for each mutual fund that has been around at least 3 years. The ratings are between 1 and 5 stars. And, like in Amazon, what would you prefer? A 3-star product or 5? 5, of course, right?
Of course, so good.
Yeah, it's good, right? 5 is good. Now, what goes into these ratings? Well, this is actually a very interesting question. It's really past returns. It's some sort of a weighted average of the 3-year past returns, 5-year and 10-year, depending whether the horizon is there for a specific mutual fund. It has a tiny adjustment for volatility. So if you have very volatile returns, you may be penalized by a bit, but it's essentially past returns. So, and this is what we see in data. Investors like 4 and 5 stars. So the flows into these stars, to these mutual funds, are positive on average. And our outflows from 1, 2, and 3 stars on average.
So just to put a point on this, flows that chase returns or chase ratings are really chasing past performance, chasing returns.
So this was definitely the case until 2002. So here's what happened in financial markets and in the mutual fund industry. Until 2002, it was very simple. You calculate this weighted average of 3, 5, and 10 years for each fund. You rank all funds in the universe. The top 10% of funds, just by count, are 5 stars. The next 22% are 4 stars. And then it goes down to 3 and 2 and 1 star. Now, you could think about the mutual funds themselves. They tend to specialize in particular areas. And in particular, they follow styles. Styles are basically a combination, at least in the Morningstar world, a combination between value blend growth and small cap, mid cap, and high cap, or large cap. So you could be one of these 9 combinations of these styles. Now, these styles are kind of in the background. So if you were a manager in the 90s and you were large and growth, these are the high-tech firms.
Yeah,
you did really well, right? I mean, this was a fantastic life to be.
Remember it well.
Right? No matter what you touch, you make money, right? You're 4 or 5 stars. Like all or most managers in this large growth were either 4 or 5 stars. Okay, life was really good. The dot-com arrives. Dot-com crash arrives 2001. Suddenly your performance doesn't look that great. You may be a fantastic manager, right? I mean, even within this sector or this style, you could be a great manager, but your performance is definitely hurt by the crash of the Nasdaq back then. Now, these managers lobbied Morningstar, saying, "Hey, it's not fair. We are great managers. We were at 4 or 5 stars, got tons of flows, managing large funds." And now our star rating plummeted just because the market crashed. I mean, it's not our fault. And Morningstar had a little committee, and basically they decided on reforming the ratings. So instead of a global ranking across the entire universe, let's now focus within each style. So we have 9 styles. Again, combinations of value, blend growth, and small cap, mid cap, and large cap. So you could be, each mutual fund is allocated to one of these styles, and the ranking are done within style. So before it was how all the 5 stars and 4 stars could have been concentrated in one cell. Now they are evenly spread. Now, for some managers, this was a great news. For others, it was less good. So if we, Ben, let's think that you're a large growth, or you're a fund manager in a large growth fund, and I'm a fund manager in small cap value fund. And let's assume that both of us are have the same kind of mediocre talent. So we're, not so good, not so bad. But you are really lucky because your style, large growth, did really well in recent history. So you enjoy 4 stars. I'm also a mediocre manager, but small value didn't do that well. Not because of my fault, just the style itself, the stocks in this corner of the market didn't do that well. So I'm at 1 star. So now, instead of comparing us, we are 2 different styles, we're going to be benchmarked against other managers within our style. So you're going to be compared to other managers of mutual funds that are investing in large and growth stocks. I will be compared to a separate group of managers who are specialized in small and value. Now, because we are both mediocre within our groups, your ranking is going to go down from 4 to 3, and mine are going to increase from 1 to 3. Both of us are going to have 3 stars. Now, what does it mean for flows? If investors chase Morningstar ratings, before the change, you were 4 stars. You will get tons of flows. I will probably get outflows because I was 1 star. Now we get the same amount of flows, probably slightly negative.
Yeah.
Does this make sense?
Crazy.
Is this something that you've seen in your
Makes perfect sense.
Yeah.
Yeah.
Go ahead.
So that's like a total rewiring of the Morningstar rating system. And we talked earlier about the importance of Morningstar ratings on flows. What was the impact of the change on flows?
So it's very interesting. It went unnoticed. So 5 stars are 5 stars. It's the same with Amazon, right? I mean, did we ever notice that Amazon modifies the way it calculates it's stars. Maybe,
So it went unnoticed in the sense that investors still chased star ratings.
Oh yeah, for sure. The 5 stars is 5 stars, no matter how it is calculated. It's the same with the Amazon products. So suppose Amazon implements a change to its ratings, right? Instead of just taking a simple average, maybe it gives more weight to recent ratings or ratings from the US versus the rest of the world or around your, location relative to the rest of the world. For the consumers, it's probably not going to make a big difference. 5 stars is 5 stars. I don't know exactly how they calculate their stars. Yeah. It seems like an average of some sort. If it changed, I'll still pursue, the high number of stars, right? So flows just went as business before. Now for managers, it made a big difference, right? For mutual fund managers, if you were in a style that was on average did really well, like in the 90s, the large and growth and later other styles, you were used to receiving tons of flows. It's not only you, it's all the mutual funds in your style, or most of the mutual funds in your style. So this rewiring basically shifted flows around, right? Before, if you think about before 2002, flows naturally just aggregate all, just sum up all the flows across funds. They went to the best performing style on average. And within the style, the best performing managers. But if you think about styles, they went basically to the best styles. I shouldn't say best styles. The styles with the best past performance.
Right.
Now, after the reform, all styles have 5 stars managers within them. All styles have 4 stars and 3 stars and 1 star. Right, so the number of stars or distribution of stars is going to be the same within each group, each style. So flows are going to spread like butter on a piece of toast, right? Going to be kind of evenly across all different styles. Now, what's interesting here is that flows in general have a market impact. So flows, think about what a fund manager who receives flows do with these flows. Well, you just go and buy more of the same stuff. You manage large growth, you receive a bunch of flows at the beginning of the month. You turn to the market and just buy more of the same stuff that you already own.
Yeah.
So you're boosting your own portfolio in a way, inadvertently. If everybody does it within your style, and all of us are buying large growth, it's going to boost this niche, these underlying securities. Okay, so there are going to be some sort of a momentum built in when there are flows concentrated in a relatively small area in style. Once flows are spread across the universe, in a way we don't have this concentrated price pressure on a particular niche of the market. So the Morningstar change seems like a relatively small change, right? It's like just, let's look, instead of ranking mutual funds across the entire market, let's just do it within style. Seems like a very small, maybe it's a one line of code in their system. It actually had a fundamental change on markets by reallocating flows across all styles instead of one style.
Yeah, that's crazy. So flows go from chasing styles to chasing managers. What impact does the change have on the time series and cross-sectional variation of style returns?
Yeah. So what we observe in our work is that prior to 2002, there was a lot of continuation, both in flows and in returns. So you could think about a fund that did really well, has very high ratings, attracts more flows. These flows basically are put to work in the market in the same style, pushing style returns even more. Your rating is doing really well. Your performance is really good. etc. Right? This is a positive feedback loop that Morningstar's reform basically broke. So we stopped seeing these positive feedback both in flows and in returns. And coincidentally, momentum stopped working around this period. This has been documented in other work. So we see that there is basically no momentum going forward in style returns. And we see also that the dispersion of return performance is much lower. Before, if the style that did really well got much more flows, which let it, continue. So the dispersion between styles was much bigger. After, it just compresses. At the same time, there is higher co-movement across styles, because styles now are governed by the same flows, the same, typically inflows to this market.
So are you saying that momentum died after 2002 and it was caused by this?
So momentum died after 2002 in the US. This has been documented by other studies. What we find is that the Morningstar change was a prime contributor. It may not be the only one. I mean, it's difficult to rule out that there were other ones. The nice thing about the Morningstar change is that we have a date for this change, June 2002. So we could really go with a microscope around 2002 and see what happened to momentum portfolios. And we see that basically, they stopped working around this date. Now, I should say the world is a very noisy place. This was a very turbulent period. It was a recession. So it's when you look historically, it's sometimes difficult to to identify precisely. But here there is like a date, right? So you could actually go and see, and it's actually not just momentum itself. It's also other factors that are related to momentum. Think about industry momentum. Think about a 52-week high. Other factors that depend on past prices. These stop to work or almost disappear.
Yeah, that's crazy. So I guess that means that using back tests to look at momentum strategies pre-2002 is a bit dicey, maybe.
Momentum. Well, backtesting in general is notorious, right? But momentum doesn't work. Interestingly, in other stock markets where the change didn't occur, momentum kind of keeps on going. Not as strong as before, but keeps on going. So, I wouldn't be surprised if there are other contributors to the change, but it seems that the Morningstar is a prime one.
Wow.
Now, I should say more generally, it's just fascinating to me how asset prices that we oftentimes think about kind of driven by cash flows and risk and risk sharing is driven by simple things like ratings and changes things, right? I mean, it's just and this wasn't like a government policy, or it's just a decision of a small group of people in a private firm making a small decision. This wasn't their intention of making these changes. It just made sense to them to make the decision just because of fairness of mutual fund investors, and it had such profound impact on the way we look at asset pricing and factors and what how we think investors price risk. Probably they don't price risk that much. They just react to these returns and to these factors. So overall it highlights the importance of what is called now demand-driven asset pricing and just institutional frictions in the way that asset prices are being set.
That's crazy. So there's like risk-based explanations for asset pricing. There's investor behavior explanations. Is institutional frictions another contributor to
Oh,
rising prices?
I think, I have no doubt that this is the case. It's obviously not instead of other explanations.
Right.
In asset pricing in general, it is difficult oftentimes to pinpoint to a specific explanation. You find correlations. Think about liquidity, for example, right? I mean, you could find more liquid, less liquid stocks. It's difficult to find a cause and effect. This is actually just happened to be a case where you could actually pinpoint to the specific effect. You could actually trace the flow. You could trace the specific funds. You have a date, right? And so it's pretty unique in this respect. And again, it's not the only factor, but it seems like institutional and structural factors are important ones in designing or in determining asset prices.
Yeah, that's a really cool experiment to use that change. You mentioned hedge fund investors earlier when we were talking about how you mentioned how they're different from mutual fund and ETF investors. Can you talk more about how the behavior of hedge fund investors is different from like what we just talked about with mutual fund investors?
Yeah, for sure. So mutual funds have a special status because they are appeal to many investors, unlimited number of investors. And because of that, they have also limitations. So they oftentimes, or I think generally the case, they cannot take leverage, they cannot enter into short positions, they cannot engage in derivative markets. They're pretty limited in what they can do. Hedge funds are kind of the private version where you're allowed to recruit up to 99 investors called limited partners. And they have to show that they are sophisticated investors, that they know what they're doing, they have enough wealth. And in return, the hedge fund itself can be a bit, not a bit, sometimes a lot more aggressive. It can use derivatives, it could take short positions, it could use leverage. Now, what's interesting is that even though we're looking at two separate groups of investors, households in mutual funds versus sophisticated investors in hedge funds, we observe very similar performance. We see a pattern, empirical patterns. One is performance chasing. The other one is kind of lack of persistence. Maybe there is a bit, but it's definitely not justifying the performance chasing that we observe. When we think about the investors themselves in hedge funds, you could think about university endowments, you could think about pension funds, you could think about insurance companies. So typically, these are professional investors, be family offices. So these tend to be professional investors who look at the performance of the hedge fund and decide to invest. Usually, these are large amounts of money being invested in each hedge fund, and the entire performance chasing is kind of a bit strange, right? I mean, why would you always put your money in the best performing one? If you understand financial markets, you know that much of it is luck, much of it is noise. So this is kind of strange, but this is what we see in the data.
Can you give us a quick rundown on the difference in fees between a typical mutual fund and a hedge fund?
Yeah. So in mutual funds, managers charge a percentage of AUM, assets under management. Could be 1%, 1 bit, maybe slightly below 1. In mutual funds, there's been a historically a common contract called 2 and 20. You charge 2% on AUM, on your assets under management. These are just to keep the lights on, they say. And then there is 20% that is paid for performance. If I perform well, I'll get 20%. So this has been since the first hedge fund in the late 40s, they say, and it persisted persists until today. Now, in reality, sometimes it's not 2 and 20. It might be 1.7 and 15%, or 1.5 and 25%. But 2 and 20 is really the most common one, even if we look at the entire range of mutual funds.
So how does the 2 and 20 structure typically work out for end investors?
So the 2 and 20 are calculated basically every period, typically every year, sometimes every quarter. So you're going to pay your 2% on the amount that you invested, and then 20% on the profits that I made. Now, when we look at the data, we actually see that over a long period, I'm talking about 22 years of data, we see that actually investors paid 50% of their profits to investors. So instead of 20% in the contract, 50% went to investors. And
that's
you may
crazy.
ask,
That's
yeah.
It's supposed to be 2 and 20 is the number everyone's heard for hedge funds, but they're actually paying...
I should say everything is legal. They pay 2 and 20, but
right.
in actuality, it becomes 50. And the reason for this is the asymmetry built into this contract.
Right.
So I want to give 2 examples that maybe will kind of square these facts. So think about holding 2 hedge funds in your portfolio. You're a large investor, you invest in 2 hedge funds. You had a kind of a mediocre year, okay? One fund made money, the other one lost, let's say the same amount. You're still going to pay fees on the gains you made, but you're not going to get your money back, or you're not going to get a rebate from Fund B. So overall, maybe you didn't make money during this year. And on top of this, you paid 20% on the gains that one of them made. But this is kind of in cross-section, right? These are in a portfolio of funds. Think about holding one fund now over time. Suppose there is one year where the fund makes money. I'm paying fees along the way, as every year I'm paying fees. At some point, the fund may lose money. I'm not going to get my fees back. Now, investors oftentimes are protected by what is called high watermark provision, which means that I will not pay additional fees until my losses are being recovered. Now, the issue is that oftentimes investors, remember, they are chasing past returns. So I will enter a fund after gains, okay? Suppose the fund continues and makes money. That's great. I'm going to keep on paying my 20%. But if at some point, and most funds at some point lose money, at least temporarily, at this point, I'm not going to get my fees back. And also what we see in the data is that investors are more likely to exit the fund at this point.
Right.
Because I'm disappointed. Maybe I lost 15% this year. I'm saying, the fund is no longer good. Maybe there is another fund. Okay, but I think about the example of going from 100 to 150. I'm paying fees along the way. Then it goes back to say 120. I'm disappointed, taking my money out, but I paid fees along the way from 100 to 150.
Right.
Now, we see also another phenomena in the data is that managers are more likely to liquidate their funds after deep losses. So again, think about the manager managing a fund going from 100 to 150, collecting fees. Now, suppose that we had terrible 2 years, instead of 150, we're at 70. Okay. In order to start gaining fees, I need to at least manage my fund to 150. So maybe it's better for me just to close down my fund and do something else with my life. So both investors' return chasing and fund liquidations actually exacerbate this phenomena. And when you just look at the data, this 2 and 20 becomes 2 and 50. So 50% of the profits that are due to 50% of the profits go as an incentive fees. And if you combine both management fees and incentive fees, you're looking at close to 65% of profits go to hedge fund managers. You know how they say, where are the yachts of the investors in hedge funds, right? It's like it's always better to be the hedge fund manager.
That's wild. So there's a cross-sectional issue where if you as an investor hold two funds, a winner and a loser, you can't net out performance, so you end up worse off there. And then there's also a time series issue where people chase performance or funds close down and you lose your high watermark credits.
Exactly.
Wild.
It is interesting. And an interesting question is, do investors anticipate this kind of behavior? And it's really difficult to know, right? I mean, we're talking about sophisticated investors. We know that some of them actually stopped investing in hedge funds. CalPERS is known as an investor who stopped investing in hedge funds in 2014, I think. Yeah. But other investors seem to be content. So it's really difficult to know what are the expectations. I wish we ran a survey, in 1995 and ask investors, what do you expect to pay on these hedge funds as opposed to what you expect to receive. If you have a time machine, send me there. Send me to the 1990s.
So what tends to happen after investors pull their money away from a hedge fund after a loss?
Right. You might say, well, maybe it makes sense for them to, who cares about the lost fee credits? As long as I don't lose more money, maybe I'm okay to pull my money after a loss. Well, what we see in the data is that actually there is very little predictability. So after pulling money out of hedge funds, actually, the returns are continuing. Just, they have no memory. They tend to be they tend to be slightly better after times that investors actually put money into hedge funds. So now these are average results, right? It's difficult to make specific recommendations, but I think for many investors it's just difficult to know that you keep investing in a fund that made a loss. It's just psychologically difficult. So maybe if you sleep better at night, maybe it's okay. But in any case, you lose your fee credits, which again exacerbates this phenomenon that you're leaving more money on the table, or not on the table, in the box. Of money. Yes.
So you're giving up the fee credits that have a relatively known value, I guess, but you're not avoiding sure losses, which is what people may be imagining they're doing.
Exactly.
So interesting. So a lot of the times when I tell people about this, I mean, about your paper specifically, and I think one of our past guests, Ludovic Falapou, has looked at this for private equity as well, or similar stuff for private equity. But the common response is that, well, if you end up in a good fund, you're happy to pay performance fees. Exactly. So I got to ask, how well did the hedge fund incentive fees correlate with hedge fund performance? Like, are investors getting the performance for their performance fees?
Right. So in our sample, the performance is very close to, very close to low single digit. It's hard to. These are averages. Now, what we see is that investors, I should say, these are averages and not risk adjusted. Now, investors pay incentive fees to managers, based on an annual basis without seeing the future. I wish we could see the future, but we have the luxury of looking back and seeing lifetime performance of hedge funds. Now, if you think about the difference between 2 and 20 and 2 and 50, there are 30% there, 30% of profits that didn't go by definition to pay for profits. They were either offset by other losses or lost later. So we call these 30% unjustified incentive fees, again, in retrospect. And we see that these fees are basically spread across the universe of performance. So many funds, or a good fraction of funds, end up with a complete loss or losses through their lifetime. They still collect the same amount of unjustified fees as well-performing funds. So these unjustified fees are basically spread across the universe and are about 1% of management fees. So one way to think about it is that when I'm investing in hedge fund, there is this friction, this 30% that I'm going to pay on profits that I will eventually lose somehow, or are going to be offset by losses, and they amount about 1% of AUM. So there are like additional management fee that I pay.
Wow.
So hedge funds are an expensive way to manage your money at the end of the day.
So just to wrap up this section, what are the main lessons for investors who might be considering allocating to hedge funds?
Yeah. So you would think that after so many years of hedge funds or investment hedge funds by sophisticated investors, there would be some contracts that will work for everybody. So one solution is the fee clawback. So think about this fund that made money one year and loses the next. Suppose you could get your money back, your fees back, instead of using these high watermarks. So this is going to be a solution. The solution of clawback doesn't work across funds, right? I mean, if we have fund A and fund B, fund A makes money, fund B loses money, we can't ask for a clawback from a fund that never received any fees, right? So this is kind of a partial solution. I think the other takeaway is that even for professional managers, intuition could be misleading. So, the big claim of hedge funds oftentimes is that, we get these incentive fees to make us work harder to find alpha opportunities. And don't worry, we get paid when you make money. So this is true for every particular hedge fund, but in aggregate, this is not true. Right. So your intuition may work for this particular contract, but if you look at the portfolio, it doesn't work anymore. And I think this is actually, there are maybe other aspects in our lives where every particular decision may look kind of make sense, but if you look at the entire picture, it may not. So intuition doesn't always work. I think this is the takeaway.
Yeah, it's so good. That paper is just incredible.
Yeah. Thank you. If you want to be the editor of my journal, I'll be. You got a job.
It's so good. The headline of that paper is crazy, like the 50% thing. But then when you read through the methodology and why it's true, it's just one of those things. It's like exactly what you just said, that the intuition just doesn't capture that kind of stuff.
Yeah, and maybe I will add to this that these are just speculation, right? So we don't have any formal evidence for this, but hedge funds are just, in many organizations, part of the portfolio of illiquid assets, right? Think about like the theory or the way things are being done in endowments and pension funds, right? I mean, you keep part of your portfolio in liquid stuff, some of it is in illiquid stuff. You don't ask too many questions about how, the fees. They are less important, maybe. You just see the annual results. You see them at a very low frequency, so you don't know exactly how volatile they are. And it's just part of the way we do things, right? We don't ask too many questions about why we do them, or do they make sense, or just part of this inertia, I think, that happens sometimes in markets or in the way that we do things in general.
Yeah. All right, I want to switch gears to another paper that is just so interesting and so relatable. I mean, I'm sure listeners will be able to relate to it once we get into it. So the topic is how people treat their tax refunds. So how do people treat their tax refunds differently from their other income and expenses?
Yeah. So we all love tax refunds, right? I mean, because one day maybe around April or May, you have another half salary in your account. So it's great. And this is what we see people do in the data. So people generally spend this money. They go more to restaurants. They have more money in their checking account. They also save a bit of it, but they almost treat it like a lottery. Like if they don't understand that it came from their own hard work and from their own deductions from last year. So we see them consuming more and saving part of it. Now, what's interesting about it, and the reason we started looking into tax refunds, is because tax refunds are the same as tax payment, just with a different sign. And people seem to treat them completely differently. So with the tax refund, people just go and spend, mainly on kind of short-term consumption, right? It's like restaurants, some of it may go towards durables, like, it's almost like my secret saving that comes, comes to my checking account once a year. But a lot of it goes to just let's go and celebrate. There is some money in the checking account. But tax payments are considered kind of outside of my income cycle. I will pay for my tax payment from my savings, not from I'm not going to, skip a restaurant this month in order to fund my tax payment. So this asymmetry between these two is what really caught our attention.
So what do all these results tell us about mental accounting?
Right. So mental accounting is a behavioral theory originally proposed by Richard Thaler, got a Nobel Prize, was my advisor at the University of Chicago.
Wow.
And in a paper with Sheffrin from 1988, they proposed a behavioral life cycle model. And it's actually a model that I find very relatable to the way I observe other people and the way that I manage my own finances. So basically in this model, in our heads, there are two entities. There is a doer and there is a planner. The doer is really impulsive, wants to consume, wants everything now. Think about it as kind of present bias, right? I don't care about the future. I just want to have fun now. The planner is thinking about the future. Now, the issue is that the doer is the one that actually does the actions, right? It's the impulsive one. The planner can only set the rules in a way. The planner doesn't tell me how to conduct my day-to-day life. So how does the planner restrict the doer? The planner does it by setting up some rules. So the rules are, for example, you can't spend on like day-to-day consumption. Think about restaurants or perishables out of your savings. It's only in extreme cases that you do that. So it's only your current income, your checking account, that could be used for day-to-day expenses. However, if there are like big expenses, fixing the roof, a tax payment, okay, these are kind of outside the labor income cycle. These should go from other sources. Think about spending income from different sources. In a way, how would we think about spending $1,000 coming from a labor income, a lottery, or an increase in our house value? Rational theory will tell you they're all the same. They're all $1,000. Doesn't matter where it comes from. Mental accounting will tell you, well, they will have different uses in a way. In a way, we're kind of earmarking our income and matching uses to the source of income. From rational theory, a dollar is a dollar, no matter where you got it. But people will assign different uses to this funds from lottery versus income versus house increase in the house value. What we see here with the tax refunds is that actually people think differently about refunds and payments. Mm-hmm. With refunds, I'm going to increase my consumption. I'm going to eat more. With payments, I'm not preventing food from my kids, but rather I'm taking it from my savings. Although essentially these are really the same things, right? I mean, tax refunds and payments are basically just adjustments to what I paid in taxes last year.
So if this is a mental accounting issue, what can people do to avoid splurging their tax refunds?
It's a great question because it can make a difference to many people. So you can think about different solutions. One solution is to not to get it directly, right? I mean, once it is in my checking account, it is just destined to be eaten, right? So one way to do that is just think about your planner. Just avoid bringing it to my checking account. So in the US, for example, you could instruct the IRS to buy government bonds with your tax refunds. So basically, you don't get it, or part of it you're not going to get. You're going to get bonds. So in a way, it makes it kind of illiquid. It kind of helps saving it. Another way could be just to minimize your deductions in the previous years. Right. So these are so in a way we're kind of finding ways to trick the doer in our minds, right? I mean, just to, or as soon as it hits my checking account, I have an agreement with myself that it all goes to saving, for example. I just try to not treat it as a windfall, but rather understand that this is kind of destined towards savings.
Yeah, great topic. We've got one more topic to cover to finish up our conversation here.
Let's do it.
So you got a couple of just phenomenal papers on this idea of miscalibration. I love these papers. Can you talk about what miscalibration is?
Sure. So these papers are part of a broader literature of behavioral biases and behavioral economics. So in behavioral economics, we think about biases from rational thinking, and there are many different biases, but the two that we're thinking about them often in kind of either household finance or financial markets or behavior of managers as executives as we have in this case are optimism and overconfidence. And one way to think about these is basically these are like first and second moments in predicting future outcomes. So optimism is going to be just being, overly optimistic about the outcomes. The outcome might be sales of my firm next year. Overconfidence is about the distribution of outcomes. Obviously, sales next year could have a distribution that could be good, bad, or maybe in the middle. Overconfidence, I'm just too sure of my forecast. Okay? And in the literature of psychology, people think about three types of overconfidence. One is called better than the average. And this kind of matches to this survey question, are you better than the average driver? The answer is, of course, and the others are morons. And it turns out that 80% of people think that they are better than the average. And then so this is one type of overconfidence. The second type of overconfidence is called illusion of control. So things happen in the world, and oftentimes we attribute these things that happen outside to our own decisions. So this was a great decision of me to invest in the stock market. See, the stock market went up 10% last year. obviously, if I lost money, it's somebody else's fault, not mine. And the third one is miscalibration. Miscalibration is really an overestimation of my own ability to make forecasts. Oftentimes, people ask in the context, not in the financial context, in order to measure overconfidence, people ask a series of questions, and the goal in these questions is going to get 80% of them correct, let's say. So this is going to be an 80% confidence interval. So these type of questions might be, for example, what is the distribution of the New York Times? When was the Black Plague? And for each question, you would give me some range. It happened between these years and these years. The distribution of New York Times is between this number and this number. And the goal of this game is to get 80% of the answers within the range. Now, as it turns out, most people are miscalibrated. They give you a too narrow interval. They are too confident in their own estimate. So this is kind of the background. Now, you could see how this type of bias is so important in the corporate world, right? I mean, in order to advance in the ranks, you'd better be a good manager. Good manager meaning taking good decisions, deciding on the right advertising campaign, and closing sales. And by being bold and being confident in your estimates, you're more likely to succeed. Now, oftentimes, I mean, this other people have shown in the research, past successes are attributed to people who have been advanced. It's I don't know whether you noticed I have a slight accent. Not everybody can notice it, but I'm originally from Israel, and there is this saying of who becomes the chief of staff in the military. It's all those who took risks and were lucky not to be killed in the field of in the battlefield. So it's the same thing, right? I mean, you take bold risks, and your overall you're a risk taker. You don't realize that you're taking risks, and you happen to survive. You climb the ranks.
Right. You studied the calibration of CFOs. How well calibrated are the return expectations of CFOs?
Yeah. So in this work, we had access to survey the trend since the year 2001, and we basically asked CFOs to predict the S&P 500 returns 1 year ahead, and provide an 80% confidence interval, basically telling us, there is 1 in 10 chance that the realized return is going to be above this number, and what is the number for which 1 in 10 times it's going to be below. So basically asking for an 80% confidence interval. Now, what we see in the data is that only about 35% of the time the realized S&P returns after a year actually hit this confidence interval. So what it means is that CFOs gave us, instead of an 80% confidence interval that we asked, they gave us a narrow confidence interval of about 35%. Okay. Now, it may look kind of counterintuitive. Any idea what is the confidence interval of the S&P 500? So if I asked you, suppose it's, take your prediction, say 8% next year, plus minus what will make 80%?
I don't know. Off the top of my head, don't know.
30%.
So so you're underconfident. It's plus minus 20%. This is kind of based on historical data. This kind of generates about 80% confidence interval. In the data, we actually see that it's plus minus 7%.
Wow.
So it's just too narrow. So instead of plus minus 20%, I would probably say less if I had to, but plus minus 20% seems kind of really wild. Yeah, but stock market returns are pretty, in 2 out of 10 years, you get, returns that are either above 20% or below negative 20%. Now, so as I said, and this kind of goes, for a very long time. So you could look at any period in these 22 years of data that we have, and on average, it's 35% of the time they're right instead of 80%.
Wow. How does CFO miscalibration respond to market uncertainty or rising market uncertainty?
So when markets are more uncertain, think about high VIX, for example, you would anticipate that the confidence interval is going to be wider, right? I mean, if I ask you in March 2020, what do you think about next year? The world could be either the economy is going to be driven to the ground, or maybe there is a rebound. Who knows? But what we see is that actually the response of CFOs is kind of asymmetric. They think a lot about the downside and less about the upside. So during times of very high VIX, we get very negative lower bound. Right? Things could be really bad by the end of next year. But we see less of an upside. And it seems, I think, a way of or representative of how people think. They especially in stressful situations, they just extrapolate. Things would be really bad next year. Yeah, maybe good, but certainly there is a potential for a downside.
Do CFOs become better calibrated as they produce more forecasts?
So in this study, we have the privilege of serving the same people again and again and again. Some of them go for 20 and sometimes even 30 quarterly forecasts. So we have the same forecast from the same people. And what we see is that miscalibration, the size of this confidence interval, is more or less constant per person. So if you tend to give us relatively narrow forecast, say plus minus 5% for next year, and you just keep on doing that, it seems that there is very little learning, if any. Just keep on doing this plus minus 5%, maybe expand or contract depending on the economy. And if you started with plus minus 15%, you're going to kind of just continue this trend. Now, interestingly, we also see that people who are kind of stay with us for a longer time tend to give us wider confidence intervals. Maybe it's because the confidence interval itself tells you something about just personal trait, tells you something about who you are, or so we see this in data.
Yeah, that's really interesting. Last question on this section. What do you think are the main lessons that investors can take away from CFO miscalibration?
So CFO miscalibration seems like an inherent characteristic of one's personality. So it's really difficult to work against. Now, ways to overcome it is really to use tools, or to use like decision support tools, to use data. If I, before asking you the question, I would tell you, the question about the S&P, I would tell you, well, here's the historical distribution of what happened in the last, 50 years. What do you think now?
Right.
Well, obviously I kind of gave you the answer, but you can think about this as a way to help people make decisions. If we're talking about hedge fund investment earlier, if you told your clients, 4 out of 5 suppose these are numbers. So 3 out of 5 investment in hedge funds end up in losses. Is this still interesting for you?
Right.
So maybe you help decision maker, whether this is an investor or executive or just household, you help them with data. So I think this is kind of what could help.
That's nice. Yeah. So basically base rates, right?
Yeah, absolutely.
Amazing. Our final question for you, Zahi. How do you define success in your life?
Oh, thank you. Thank you for this question. So this question actually was the topic of dinner conversations at my household for a few nights. So I have 4 kids, ranging between ages 10 and 21, and
Wow.
we had a conversation about success and goals. And my kids reminded me that I oftentimes told them to push the envelope. So you should work as hard as you can until you fail, and then you know that you succeeded. So if I try to kind of generalize this, success really depends on the goals you set to yourself. And in an absurd way, you kind of work to the max and probably succeeded once you start seeing failures. Until then, things are probably too easy for you. And this is what I try to preach and try to live by. Sometimes more successful for than other cases. So success is sometimes could be failure as well.
That's a really, really cool answer to the question.
Is it the coolest ones that you received?
No, we've had however many 100 or whatever, but it's that's a unique answer. I can say that.
Yeah, but Ben's going to give you a high cool rating for having 4 children.
I've got 4 kids too.
Yeah. So
awesome. Great answer to the question. This has been a fantastic conversation, Zahi. We really appreciate you coming on.
Yeah, it's been a pleasure.
Yeah, great to meet you. Thanks so much for coming on.
Same here.